And welcome back to the second hour of our program. Thom Hartmann here with you. And John Berlau is with us. He is the director for the Center. Let me get the button over here. The director for the Center for Investors and Entrepreneurs at the Competitive Enterprise Institute, CEI.org. John, welcome to the show.
Thanks for having me on, Tom. Good to be on again.
Thank you. It's always good talking with you, John. It looks like this whole thing of avoiding taxes, corporations avoiding taxes, began in 756 when the Vatican became a tax haven, Vatican City, and then 1241, the Hanseatic League became a tax haven. In 1721, the American colonies were trading with Latin America to avoid British taxes. This is nothing new, but what we have here, I think the most egregious of these things is transfer pricing. This is where if let's say a printer manufacturer, a computer printer manufacturer decides to make printers in China, they sell them to themselves from China. They set up a division in China. They sell them to themselves from the division in China at, say, a very, very high price out of China into the United States because we charge no import tariffs anymore. They pay no tax on the import into the United States. The profit is kept in the Chinese company. The Chinese company then sets up an offshore division in the Cayman Islands. They move the profits there, and that's where the profits rest, and they pay absolutely no taxes on it. And Barack Obama says he's going to take this on. John Kennedy was the first guy to do this. In 1953, he gave a brilliant speech on this when he was in the House of Representatives. In 1961, he tried to take it on as president. He was unsuccessful. Why are there so many Republicans and tragically a number of Democrats like Max Baucus who are speaking out against or in favor actually of allowing corporations to continue this practice of evading paying their income taxes?
Well, Tom, I would support possibly some of what President Obama is trying to do as part of an overall package of corporate tax simplification and tax reform like we had for individual income taxes in 1986, where you had some tax cuts. I think the problem is we're one of the only countries in the world where foreign income, foreign profits are actually taxed. Other countries have what's called a territorial tax system where they just the money they make within their borders is taxed, but yet we tax the global income of our corporations and have a system of refunds like on the value-added tax they may pay in other countries. So with that system, you do have a lot of gamesmanship, and you probably have a lot of
that's not altogether accurate, John, because in other countries, while they may not tax the operations, the profits of offshore divisions and things like that, and ultimately probably we won't either unless they're specifically for the purpose of avoiding taxes. They do have, because of value-added taxes or because of tariffs, they do tax the products or services that are, primarily the products that are being made every time value is added to that product, regardless of where in the world that value is added. So they're recovering those taxes. We don't do that. We don't have a VAT in the United States.
I mean, that's another debate, whether you want to have a VAT or, I would be open to it like a national sales tax, depending on what the rate is. But again, if you have these things, these deductions where they can't deduct the VAT and things like that, without overall corporate tax reform, including even Charlie Rangel wants to raise other taxes, but said talked about it decreasing the federal corporate tax rate from 35% to 30%. I think you might have a situation where U.S. manufacturers or their hands are tied behind their backs, and so are those of their workers, and it might work against goals like making GM and Chrysler, companies like that, internationally competitive.
I don't buy it. In 2004, this is from the White House's press release, as it were. The following statement issued by the U.S. Treasury, and you can find it over at Financial Times, FT.com. In 2004, the most recent year for which data is available, U.S. multinational corporations paid about $16 billion in U.S. tax on approximately $700 billion on foreign active earnings. That's profits. An effective U.S. tax rate of about 2.3%. And since we know that more than 50% of all international trade is U.S. corporations doing business with themselves, with overseas subsidiaries, and there's a pretty good guess that that number may actually be as high as 85 or 90% because they're doing them through so many shell companies that, it's not overtly Hewlett-Packard, U.S., Hewlett-Packard, China kind of thing, that many of these companies have differently named divisions. What we've got here is a giant Enron scam. You know, the 100 largest U.S. corporations, 83 of them have subsidiaries in tax havens. This is just wrong. Why, you know, John, how can the Republican Party, I mean, they are like staking this as a principle that they're going to defend tax cheats, corporate tax cheats, but they want to make sure that you and I pay our taxes.
I want to make sure.
It's going to kill them.
I think they would be better off, and I think some of them have, you know, like he was formerly an former Congressman Dick Armey, things like that. I mean, a territorial tax system, a more simple tax system where, you know, profits, you know, earned here are taxed, and outside of the country they're subject to other taxation.
But here's how it plays out, though, John. Let's say that you know, a company is making a printer that sells for $100 in the United States, and it costs them $10 to manufacture in China. So that company manufactures it in China, and then they sell it to themselves in the U.S. for $90. So they've got an $80 profit in China. They sell it in the United States for $100. They got a $10 profit in the U.S. on which they pay taxes. That $90, that $80 of profit that's being kept over in China, because they control the transfer price. They decide at what price they sell to themselves. There's no free market here. This is a company with another company, but it's wholly owned. And then they move that profit, and that secondary corporation that's doing business in China is actually domiciled, it's headquartered in for example, the Cayman Islands. I mean, this is what Halliburton did. They moved KBR, which was their most profitable division, that was getting all the U.S. contracts to ultimately electrocute and feed poison to our troops in Iraq. They moved that to the Cayman Islands so that they wouldn't have to pay taxes on it. I don't see how anybody can justify this.
Tom, you might, with a territorial tax system, you might very well get a higher level of taxes being paid. It would be easier to enforce, and you could cut down on some of the games.
What's a territorial tax system? You're using a phrase I'm not familiar with.
That is what most countries in the world have, where, I mean, you know, with they may have with the value-added tax and things like that, and that's another debate. But the earnings, you know, within the country's borders are taxed, and those, you know, made by a company internationally or not. So,
but that's my point, John. Is using that $100 printer as an example. If that were manufactured in the United States, where the manufacturing cost might be, say, $30, there'd be a $70 profit in the United States that company would have to pay a profit on. By making it in China for $10, but selling it into the United States at $90 to themselves, they keep that profit outside the United States in a totally phony way. I would submit to you that the vast majority of that $90 profit really should be considered a U.S. profit, because it's a U.S. company making a U.S. product that is labeled and printed in English to be sold exclusively in the U.S. market. They just happen to be using Chinese labor.
That may very well be something that a territorial tax system would capture, but you also have situations where companies, you know, trying to sell, if you didn't have these deductions with companies just wouldn't be competitive overseas, because they would be subject to the value-added tax and all the taxes overseas.
But they can deduct those things right now. Barack Obama's not talking. Obama's not talking about doing away with that. Corporations, if they're actually doing business overseas, if they're not just arbitraging labor, if they're not just offshoring labor, basically, if they're actually doing business overseas and they pay taxes on the profits that they generate overseas to those countries, they get a tax credit in the United States for that. What he's opposed to is the fact that they are accelerating those tax credits and amplifying those tax credits here. They're claiming more than they actually paid, and they're bringing all their expenses into the U.S. so that they can get an expense deduction here that's inappropriate to the actual expenses. They're just playing games, basically.
Well, we'll have to, I mean, there may be, I mean, they can deduct value-added taxes as well as, you know, sometimes the income taxes and the primary source value-added tax.
Yep.
And I'm saying with that, I mean, these are going to be debated and looked into and hopefully refined. But I mean, I'm saying that, you know, if you do some of these without overhauling the system, or without cutting the level of the corporate tax rate here, or moving more toward a territorial system where it's, you know, within the U.S. borders, and then you could be hurting international competitiveness with
Yeah.
this.
Well, I'd love to see it all within the U.S. borders. To say to these companies, sorry, it's not going to be profitable for you anymore to manufacture something in China because we're going to hit you with a tariff when you import the product or a tax on the profits that you're making over there. So you might as well make it here. I think it'll bring a lot of jobs home, and I think that.
But we do want them to sell in China, though, all over the world.
Oh, sure. Yeah, and if we're going to sell in China, then
our tax system could be an impediment to that.
yeah, then we certainly we want our American companies to be competitive. I think we can agree on that. John Berlau, he is the director of the Center for Investors and Entrepreneurs at the Competitive Enterprise Institute, CEI.org. John, thanks for dropping by.
Thank you, Tom.
Always good talking with you.